Welcome to Transfer Pricing 201, Transfer Pricing for Tangibles. Today's video is going to introduce the cost plus method. So the cost plus method is another method we use for establishing the arm's length nature of the transfer price. What I actually say is that the transfer price is within the arm's length range. And we do this by looking at the gross margin, or actually the gross profit relative to the cost of goods sold. And by looking at that and comparing it to either an internal or an external benchmark, we show that we make the same return above these costs of goods sold, whether it was related or unrelated party transaction. So this is most commonly done where you'll see the taxpayer, in this case as a manufacturer, they're buying inputs, and those are usually bought from unrelated parties. So their inputs, which are part of cost of goods sold, are considered to have been bought at an arm's length price. They then sell the product on to a related party. And the question is, do they make enough profit in that sale, and that's the gross profit, to cover all the costs of putting the product together? So this is most commonly used as a method when the related party that you're examining is manufacturing or assembling something, somehow producing the good, but most commonly not using a valuable intangible. So remember, our challenge is always going to be to show that the price we're charging in the transaction, I'm going to bring up a pointer here so we can mark it. The price is right here. We sell something for a price times the quantity. It shows up for a distributor who's purchasing for us, it shows up in their COGS, but as the manufacturer, it's going to be our revenue line. And in the case of the related party manufacturer in this case, using the cost plus method, we're going to examine essentially their gross profit, the difference between revenues and COGS, relative to the amount of COGS that they have. So we're going to take the gross profit, which is right here, and that's going to be our numerator, and we're going to compare it to this, the COGS, our cost of goods sold. Now, I'm using the phrase cost of goods sold, but many times you'll often see the phrase cost of sales. So by looking at that ratio, which is given in the equation here, gross profit divided by COGS equals cost plus, and that's essentially it's the profit level indicator or the test statistic we're going to use. And what we're going to talk about next are some of the issues in measuring that, because that'll be very important to determining whether we have comparability in our analysis. So what's the specific definition of cost to be marked up? And in that case, we're talking about the cost of goods sold. In the cost of goods sold, we need to distinguish between essentially what is part of cost of goods sold, and because that's in our denominator, and also then that's going to include the labor costs that we have if we're hiring workers, the manufacturing overhead costs, including depreciation because we have a factory, let's say, using machines, they are all depreciating, and the purchased materials costs, those things that we have to buy, such as materials, steel, copper, whatever, to turn it into whatever product we're making. What's not in that cost base are the operating expenses. They're not in the denominator when you're calculating the cost plus. These would include such things as the selling expense, including any advertising, the general and administrative expenses. In fact, you'll often see operating expenses in a financial statement be listed as the SG&A, the selling, general, and administrative expenses. It would also include essentially charges for management, marketing, accounting, finance, and can include research and development. Now, for a firm to be efficient, or for an efficient firm, essentially, you have to think that the gross profit that they're earning has to be sufficient to cover all of these operating expenses and leave a return for the investment in capital, that entrepreneurial risk-taking. Well, thanks for watching this video. Our next videos are going to include some examples of how we actually execute a cost plus method.